Denise, it's great to have you here this morning. Let's talk numbers because you crunch a lot of them. Are we seeing a market that has some legs to keep going higher, or are we due for a pullback?
So I think earnings is going to be the key driver in 2020 after some of the dislocations and rare signals that we saw in 2019. So that's the key indicator that I'm watching. And two of the leading indicators for earnings growth have turned in the last, let's call it 3 to 6 months. The first being the OECD Leading Economic Index, and the second, which is a little more significant, which is the Small Business Survey and the number of companies actually expecting earnings growth to inflect higher. Both of those actually suggest a reacceleration in earnings growth after the poor earnings growth that we've seen over the last year. And most importantly to the market, as much as we want to focus on what it will reaccelerate to, what's very clear in history is that inflections matter more than the overall level. Even if you had perfect foresight and knew what earnings growth was going to be, as long as it was positive, they all still carry 75% odds of an advancing market. But this inflection that some of the leading indicators are suggesting actually carries 90% odds of an advancing market over the next year. So that could give this equity market legs over 2020.
All right, could, but 90% sounds pretty darn certain at this point, a 9 out of 10 odds. Is this a scenario where the numbers are actually going to back up this notion that earnings growth and everything else, a macro environment, can see the stock market keep going for quite some time?
Right. So it's interesting when you talk about the macro market, macro economy. When I look at the numbers historically, what you see is despite the fact that GDP didn't contract, if earnings reaccelerates, even if GDP didn't contract and doesn't reaccelerate, you still see, when I look at the sectors through a sector lens, you still see defense like consumer staples, utilities, healthcare, and to a lesser extent, the old telecommunication services industries. You see very low odds. So despite the fact that even we can talk about the market, but a rotation back to those economically sensitive sectors out of defense actually seems likely throughout the course of 2020.
All right, so if this rotation pans out, we know that there are rich valuations in some of these defensive-oriented sectors here, but there are also rich valuations in places like technology, industrials, other places as well. What exactly then does the sector outlook feel like in the next year or two, given those numbers that you just cited?
Right. So I still see the severe dislocations that we saw in 2019 persistent. That was one of the key drivers, even though that were rare signals, of the upmarket in 2019. So defense, as you mentioned, again, consumer staples, utilities, healthcare, and telco aggregated together were in their top decile of relative valuation since 1970. And that's had decisive historical odds of a rotation back to cyclicals. As much as you've seen that come off a little, we're still in the top decile range, which is still supportive of cyclicals. Now, technology, again, an economically sensitive sector, when I look at the valuation relative to history, relative to the market, what I see is a very unique setup. It's still below average on earnings and free cash flow, but still with top decile EBIT margins or operating margins. So technology is still a sector where you're actually getting value relative to history for some of the best fundamentals the sector has actually put up historically.
All right, Denise, we just got about 30 seconds left here. What derails that bullish thesis, that 90% odds that things keep going higher?
I think inflation is one of the key indicators to watch because that is what allowed the Fed to actually shift this cycle positive versus other cycles after prior yield curve inversions. What you saw is the Fed hike interest rates. The Fed lowering interest rates 3 times may stimulate, if history is a guide, bank lending standards out to 2020, supportive of job growth to extend the economic cycle and continue the rotation back to cyclicals.